Aussie, and welcome back to the Options Brit. Now, as we discussed in the last video, in the last 12 months, I've managed to turn $25,000 into $100,000 using 3 core strategies: cash secure puts, covered calls, and leap options. But more importantly, I've done it by only trading stocks that I genuinely want to own, stocks I understand, and stocks that I genuinely do believe in. And that has led me to a personal belief that I'm here today to share with you guys. I've redefined what a loss even is to me, because when your worst case scenario is owning a company that you already wanted in your portfolio anyway, is that even really a loss? Think about that. Your worst case scenario is what you wanted to start with. So how can you lose? This isn't financial advice. I'm not a financial advisor. This is just a framework that's worked for me, an idea that I've built over time based on intuition and basic understandings of what makes a good growth company, and guidance from a lot smarter people than me on YouTube and other content creator sites, and some very basic charting tools. That's all I use, nothing else. Let me show you exactly how I do it. Okay, so right, where do we start? Starting point for my strategy is a cash secure put. This is where we begin. So I would look at a company such as SoFi, and the basic premise behind a cash secure put is that we will sell the put price that we decide that we want to pay for the stock. It's effectively saying to the market, no, we don't want to pay what it is at now, but we will get in when it gets down here. We choose our entry point, and not only do we get to choose our entry point, we get to get paid for that entry point as well. Let me show you what I mean. So we've got SoFi here. I've already got a cash secure put trade open on SoFi, so you can see here on screen I've got 20 cash secure puts that I've sold. I sold them for the 1st of August. They have 15 days remaining, and I sold them at $15 strike price. Now, we know that SoFi currently is trading at around $20 to $21. It's even pushing 22 at the moment. So what's happened is that when I bought those, I'm now becoming more and more profitable on the trade as time goes by, okay? At this precise moment in time, I've accumulated $640, which is 80% of the initial premium that I was paid to sell those cash secure puts. I can cash out of this right now and walk away with the $640 premium if I want, at this precise moment in time. Or I can wait to collect the other 20% if I want, okay? That is how the cash secure put works. This is how it looks whilst it's working on a Tasty Trade platform. But how do you set that trade to start with? Well, we go into our trading platform here. Sorry, I've got one open up, close that one down. Let's say, for instance, we want to go, a month out. So we'll go 36 days. SoFi currently trading at 2021, but we might not want to get into SoFi just yet. We might want to pay, let's say we decide we want to pay $18.50 for it. So we would come down to the $18.50 strike price here, okay? Now on the right-hand side, we've got puts. On the left-hand side, we've got calls. We are looking at selling the put here, okay? That's what this column is. So these figures here indicate what we are going to get paid if we decide to choose that strike price. So you will see here, the $18.50, we're going to get paid 45 cents. Now remember, when we're talking about options trading is always in multiples of 100. So we're talking about getting $45 here for this contract. So if I click it, you'll see there that it's gone red. And down here now, we've got one cash secure put for 36 days for $18.50 strike price, okay? We are going to get paid $45 over here. And all that we need to do is hit review and send, and that's it. We wait for the market to do its thing, and we've bought that cash secure put. What we are then waiting for is, if in that 36-day time period, SoFi drops from its level where it currently is at the 21-22 mark, and it drops all the way down to 18, we will still be obliged to buy that stock $18.50, okay? If it stays above $18.50, we get to keep the premium and we do not have to buy the shares at all. But as we said at the beginning, this is a win-win situation, because if it does drop to the $18.50, we've chose that strike price. We've decided that that is what we want to pay. We cannot lose. If it doesn't hit that strike price, we get paid for our time and trouble. If it does hit that strike price, we get to buy the stock. It's as simple as that. It's so easy, and it is literally printing free money, guys, okay? Okay, now on to part 2 of the strategy. So once I own the stock, I move into the next phase. The next phase, covered calls. This is where the money really starts to flow, okay? I sell call options on stocks I hold to generate weekly or monthly income because I know the stock, I know how it reacts to earnings, resistance zones, and news. That helps me avoid overwriting at the wrong times. The premium becomes cash flow, reducing my cost basis every time I collect it. It's boring, but it's repeatable, and it's highly profitable when you're using it on quality companies. So let's get into some examples of covered calls, and I'll show you how I make that covered call. So another one that I've got here already open. I own 200 shares of Hood. Okay, I bought these shares a couple of weeks back. I've opened up 2 covered calls on these shares, so I'm covered. I've got I own the shares, and I've sold 2 covered calls. I've sold these for the December the 19th date, $140 strike price. Okay, so if on December the 19th the price of Robinhood hits $140 or above, my shares will be called away. I will be paid $140 per share for my 200 shares, but I will have also collected a substantial amount of premium here. You'll see, still got quite a lot of time left, and already I'm $244 to the good on this one. So covered calls can be so powerful because you don't just gain from the premium, you gain from the stock appreciation as well. That's why the covered call is where the big money can be made. All right, you can also make a lot of money on the LEAPS, which we will go into shortly as well. That will be the next part of the strategy. But covered calls, you don't just collect the money from the premium that you're being paid for those shares. You also get the stock appreciation. Now, you've got 2 ways of looking at this. So your stocks, visualize your stocks as a property, and you are the landlord. All right, you're renting those stocks out. You're collecting in rent. The problem is that if it does hit that strike price, the person who's renting that house off of you does get to buy it for that price. That's the best way to visualize that. Your cash secure puts, you are an insurance salesman selling insurance to somebody who owns that stock to say, if it does drop a little to this price, I will insure your stock for you and I will give you this price that you have decided you want, but I want that money for it. I want that premium to be able to put my money aside for that period of time to be able to buy it. Once you have bought it, you then become a landlord, okay? On the other side of this trade, the covered call, you are the landlord. The stocks will be bringing in rent for you. But as I say, the issue here is if it does hit that strike price, you will lose your shares. There are things that you can do if you don't want to lose your shares. But like I said, I'm talking about a win-win situation here. You're gaining from stock appreciation. You're also being paid for the privilege, okay? And you get to choose that strike price. That's what's so powerful about this. You don't just have to sell your stocks for a knockdown price. You can go as high as you want with it and still get paid the premium within reason. Let's go into the platform and I'll show you how to set this one up. So again, if we start going out a month out, 36 days, you can see now we will be going onto the call side rather than the put side, okay? So we will come all the way down here because we want to go out of the money to sell these. So the stock is currently trading around about $105, okay? So, you know, we buy it, let's say we've bought 100 shares at $100 and we want to sell them when it gets to $120. Well, we'll go up to the $120 strike price here and we'll come across to the sell column here and we'll see it's $4.50. So if we click that $4.50, you can now see down here that we are selling ×1 covered call for August the 22nd for $120 strike price, okay? So we would be paid $450 right now. That money will come straight to us. We get paid that instantly. It will go into our cash balance for us to be able to use. If at the end of the contract the stock price has rose to the 120 or above, your shares will more than likely be called away. However, you haven't just gained the $450 premium that you've been paid here. You've gained the $20 stock appreciation. Now remember, that's times 100. So you're gaining that money. You've got stock appreciation and premium. Again, guys, that is why covered calls are so profitable, because you get paid on both fronts, okay? Let's move on to the next strategy. So the final strategy that I use is LEAPS, long-term equity anticipation securities. These call options with expiration dates over 12 months out. They let me benefit from long-term upside in a stock I believe in without committing the full capital up front. It's like renting the upside of a great stock. I combine LEAPS with short-term covered calls to create synthetic income as well. This is powerful if you pick the right stock. I've used LEAPS on high conviction plays like Nvidia and SoFi, which I will go into and show you now. All right, everyone. So what we've got here, you'll see ×4. These have actually had for a while, so they're under a year left on them now. You'll see they've got 183 days left on them. But what you'll also see is that they are over $13,000 in the profit if I was to sell these now, because I bought these back when the stock was at around about $110. So you'll see that I've gained quite a lot of money based on price stock appreciation, over $13,000 on this. This has been a very, very good trade for me. I intend to hold these a little bit longer. With LEAPS, you don't really want to be holding them past 90 days, because what happens is you've got something called theta, which fights against you. That's for a different video. I'm not going to go too much into that. Don't want to be holding them when there's only 90 days left and below, okay? Try to be looking to get out of it before that time period, okay? What you don't want is that you don't want that price to start going down, because the contracts are losing value. The closer they get to expiration date, the more value LEAP options will lose, okay? So you need to be getting out of it with around about 90 days left. That's about optimum, okay? So yeah, I'll be looking to get out of these in around about another 80 or 90 days, but I'm hoping that the stock will go up quite a bit before that happens, which means that the price here will also go up quite a little bit. Let's go into a chart and show you just exactly how you would put these on. We've already talked about timings of LEAP options. We're looking for something at least a year out, ideally. So if we go to 428 days, ideal. It's over a year, but it doesn't matter. You're looking for at least a year. So what we're doing with this one, again, we're coming back over to the call side, but we are looking to buy a call. This is one of the very few times that I will look at buying options rather than selling them. I don't like doing spreads, verticals, or anything like that. We'll do strangles, but we only do strangles because a strangle is selling a put, selling a call. So all we're doing is we're collecting the premium that we've discussed over the last two strategies at the same time. That is literally all that is. So it's not swaying from the strategies that I've told you I use. It's just doing them at the same time, okay? Which again is a very, very strong and powerful way of getting some income. But we'll go over, again, that's for a different video. Back to the LEAPS. So we'll be looking here to see whereabouts we think that the stock is going. So I'm a big, big, big believer in Nvidia. Anybody who knows anything about trading will probably be or will have traded Nvidia in the past. It's a strong company, it's got plenty of growth, and they beat on earnings and expectations on a quarterly basis without doubt. So I'm under no illusion that this is probably going all the way up to 200 at some point over the next year. So I think that we're safe around about where we are. I tend to go around about at the money. Now you can drop a little bit deeper into the money if you want for a little bit of security. You'll see here deltas, basically the closer to 100 or the closer to 1 rather that you get, price action will reflect the stock price action a lot closer as that stock goes up, okay? So if we select the buy call option for an at the money, we can see here that we will be paying $3,600 for this option. That will give us an option to buy 100 shares of Nvidia for the next 428 days at $170, okay? So if this goes to $200 by Christmas, the price of that option will have rose considerably from where it is, and we'll be able to sell this on for a profit. Or wait even longer if your conviction goes beyond $200 and wait till it gets as high as you believe it's going to go before you sell it. If it doesn't get to that point, or it's hovering around a nice area, as we've discussed before, make sure that we get rid of that contract before the 90-day period, okay? Do not let it lapse the 90-day period, because theta will then start eating into that contract, and that is something that you do not want to happen. That's where you lose your money. Okay, guys? All right, so here's what ties all of this together. I'm building positions with a mindset of a long-term investor, but I execute them with the precision and speed of a day trader. When the profit's there, I'll flip the position, no hesitation, because I'm not emotionally attached to any of my stocks. I've already made peace with the outcome the moment I place the trade. And that's why I say I've redefined what a loss even is. If I get assigned, great. I wanted to own that stock. If I collect the premium, great. That was the plan all along. If a LEAPS contract dips, I'm still in a company that I trust over a long period of time. It doesn't matter. This mindset removes stress, it removes the gambling, and it makes the system and process repeatable for me. And that is exactly what I've done over the last 12 months. And you can see from the profits and gains that I've shown you guys. This is just what's worked for me. I'm not the smartest trader out there, but I've built something that's turned into unbelievable returns over the last 12 months that's worked for me. If you like this way of thinking, hit that subscribe button. I'll be sharing all of my live trades, my performance updates, and deeper dives into each of my strategies. Options trading doesn't have to be high stress or high risk. It can be structured, it can be logical, and it can be absolutely profitable. Thanks for watching. I'll see you in the next one. Bye for now.